Hey, welcome back to Everything Money. It's Seth, Paul, and Mo. Today we're talking about the company Five Below, a retail store. Paul, we've got a lot of requests for this company in our Discord community at everythingmoney.com. People want to hear your thoughts on this. We know very little about this company, I assure you. Go to some other YouTuber who spends 8 hours looking at Five Below. We are going to use our initial stock screener, our 8 pillars to see, are we interested in this stock? What are their financials? Are they buying back shares? What is their debt like? These are initial steps you should be using as an investor to take a look. If you've never heard of Five Below, we welcome you. Paul, go ahead.
First off, follow us on Instagram. It helps our egos out. Secondly, everybody who claims to do due diligence, all they're doing is reading articles on the internet that's not due diligence. If they claim that, Jimmy does due diligence. Jimmy from Learn to Invest, he does a lot of due diligence. He likes to find the companies he wants first and then show you his numbers. We do the exact opposite.
Yes.
We just take a company and say, do we like this? So we start from the high level because our goal is to weed things out very quickly.
And we very much might be partnering with Jimmy from Learn to Invest. Paul, I'm thinking we'll do like videos where we pick a stock and we do the initial screen and he'll do the deep dive and we'll share patrons. It's a very exciting thing, a partnership we have moving forward. But go ahead, Paul, show us. The ticker symbol is, of course, 5. Go ahead.
Okay, guys, $10.4 billion company. 5-year PE of 72.3.
Perfect.
That's an X. We want it less than 22.5. All right. Let's see here. No dividend paid. Makes sense. Return on invested capital, 5 years of 4.1%. That's poop. All right, so 2 X's so far. We want this over 9%. What this says is they don't really reinvest their money at high rates of return, which is kind of weird because it involves opening stores. They have 1,020 stores in the United States. We have one right at the corner of 82 and Brecksville Road.
Okay.
Not 82, 18 and Brecksville Road.
You shop there often?
I do, for my clothes.
Pillar number 3 is revenue growth for the past 5 years.
All right, revenue growth. 1.1 billion to 2.58. Now, guys, what am I going to say about any retail location?
Same store sales, Paul.
You need to find out how much of this revenue growth is opening new stores versus same store sales growth or comparable store sales growth. The reason being is you want to make sure their growth isn't coming from opening more stores only. You want to make sure that every individual location is also growing its revenue. That way they stopped growing the number of stores, they're still growing their revenue. That's important for all retail sales.
Pillar number 4 is profit growth over the past 4 years. 5
Net
years.
income, 80 million to 260. Check mark there. It's a big jump. Big jump. Look at 10 years ago, 13 million.
Wow.
This company be growing.
Shares outstanding is pillar number 5, Paul.
All right, 55.15 to 56. That's an X. So slightly 2% more, whatever, not a big deal. I'm not worried about it too much. Now, remember, guys, we saw here the 5-year free cash flow average was 78 million. What my goal is with any company is, our 6th pillar is to look at long-term liabilities, divide it by the 5-year average free cash flow. We want that number to be less than 5. What that means is if they replicate the next 5 years of free cash flow, how long would it take them to pay off that debt? So what we do is we take 78.5 multiplied by 5, and that is 350 and 40, call it 400 million. It's not 400 million. No, it's actually over, wait a second. Is it 400 million? 78.5 times 5. Can I get a witness from the congregation?
Yes, 78.5.
Yeah, 392, yeah.
All right, 392. So call it 400. Now, with retail locations, you have to be aware that a lot of times they're going to capitalize their leases, which will add their long-term debt. It'll be to their long-term debt. So it might be misleading here. Their total liabilities are 1.12. But look at this. 1.08 of it is capital lease obligations. So they have very little total long-term liabilities except for their leases. And they can sublease, they can do other things. It's not the full lease amount, but still, we go based on the numbers, and it's an X right now for that reason. All right. So if you like the software, guys, we created the software because our users requested it, okay? This is very specific. What it includes is the mobile app, 8 pillars, 30 years of financial data, stock analyzer tool, exclusive daily content, access to all 3 of us, real estate calculator, most importantly, Discord community with over 6,300 people who have access to it, all for only 87 cents per day, less than a crappy cup of coffee. If you were serious about financials and your finances, this is a no-brainer. You get all of this. Our competitors are $200, $235 a month. Guys, this is a no-brainer. Everythingmoney.com or click the link below for Patreon. This is absolutely awesome software. Everybody loves it. Go do it. So the big mamma jamma now, Seth, is
Pillar
what?
number 7 is free cash flow growth over the past 5 years.
So free cash flow. It's cash from operations less your capital expenditures, right? This is what they use to buy back shares, pay dividends, make acquisitions, and
buy back shares, acquisitions,
pay down debt.
There you go.
Great. So we're going to look at the growth of the last 5 years, 69 million to 219. There was a negative here and a huge year, so the negative was probably because of COVID.
Yep.
An average of 78.5. So we're going to multiply that by 20. Why do we multiply by 20? It's just a starting point for evaluation of the company, right? We take that number and multiply by 20 and say, okay, this is $1.57 billion. Is that accurate? Yes, it is.
1.7?
1.57.
1.57?
Is that right?
Yeah, the actual market cap is 10 bill.
So this is very overpriced. Now, the one thing I'll say is it's about 6 times overpriced based on that metric. And look at the PE. The 1-year PE is 40. So if you decrease that by 6 times, it makes it a PE of 6 to 7, probably too low. Now, the company is growing, but I will say this, guys. The 5-year PE of 72 makes, if you divide that by 6, that's 12. For a retail company like this, I don't know. Maybe that's a reasonable number. I have no idea, but I do believe
they had 980 stores in 2020. They're up to 1,120, Paul, and they're actually planning on opening 170 more this year. I mean, that's 10%. They are growing, and they are not seeing. Folks, I just went to the 10K, which you can access through our software, just 2 clicks away. They are not growing same-store sales.
They're not.
As far as I can tell, they are not growing. The increase in comparable sales is primarily a result of.
Well, it's going to be primarily. I mean, same-store sales won't grow a ton. But you want to see some growth. Have you looked at any growth of it? Did you search for the word comparable? So what we're doing here, net sales increased 646 million in the 13 weeks ended July 31st from 426. The increase was a result of comparable sales increase of 155 and a non-comparable sales increase of, okay. So the actual comparable sales growth was really big.
Oh, yeah, 3 times as much. I'm wrong. Look at that. So they are doing well.
Yeah, it looks like they are doing well. But what is this negative here? Scroll up a little bit. Why is it negative 30? What's the date on the negative 31%? Oh, there we go. That's why. Obviously because of COVID.
Yeah, and they closed down for some weeks.
And there was also big growth because of people coming back. So
interesting.
You want to look back further than just the last 2 years. You want to go back even further than that. Have they been able to drive same-store sales up as time goes on? That's a very important aspect here.
Mo, are people trading this in the Bid-Ask Nation?
I mean, look at this run that it went on from this was 2020 and it went up. The reason I've scrolled out this far is because right in the beginning of 2021, it kind of hit this level and you can see that it's just been consolidating in that area with the exception of that little blip that happened in maybe August. So the good thing is from this aspect right now, you notice that the stochastic is down. This is a good tracker share stock because you can throw something on here and just wait one share, wait for this to move up through the sweet spot. There's a gap that needs to fill there. You're likely not going to drop any lower. Now, what's the stock again? 5 below. I mean, I look at it as if we do hit some kind of recession or something like that, it's probably a pretty good stock. It's $5
That's
store.
true. I didn't even bring that up. You're right.
Yeah. So, I mean, this is definitely something that I would keep on my watch list and just let it roll because this thing does have, I mean, this has room to grow. The chart looks very good. I love this basically 9 months of support that it's held very, very tightly. You don't see that very often.
If you're interested in trading, that chart might look kind of confusing, but if you get into it, learn for a few months. Mo, go back. I love seeing long-term.
Yes.
Look at this. If we would have followed Mo's rules, go back to behind it to your left.
Yeah,
it's
it's very simple. I mean, you grab a stock when it moves into the sweet spot. Your buy signal would be somewhere in here with an engulfing candlestick, and you just let it roll. And once you get into this overbought area, you can see there was no reason to sell.
When would you have sold?
Right here. Right when that.
What price was that?
Let's see here.
So you'd have bought at what price and sold at what price?
Yeah, that's true. Let's see that, Mo. I mean, these are the rules that Mo's been preaching in the Bid and Ask for.
I probably would have purchased at, let's call it $85, just to use round numbers.
Okay.
And I would have sold at, when did this drop? 175.
I mean, is doubling your money good?
Yeah. And the good thing about this one is you didn't see this stochastic at all ever drop into the sweet spot in the negative direction because that's the sell signal. you had nothing here except just going sideways, and that's just a power stock, buy and hold, wait, make money.
And then you have a sweet spot reversal here where you would have rebought, and then now.
Yeah, so the tough part about over here is it kind of lost steam, and now it's just kind of doing that. It's just bouncing around in there.
So when would you have rebought?
I wouldn't have rebought yet.
No.
Yeah, because you have to wait for it to fall below the lowest
Correct.
stochastic, right?
So I like that this stochastic is down here now in the oversold area. Now what I'm waiting for is this red line to turn back up into the sweet spot and give me another run similar to back here in 2020. That's what I'm waiting
I bring
for.
this up, folks, because it has nothing to do with news. It has nothing to do with sometimes it has something to do with opinions, but in essence, if you just stick to the rules, if you are a robot sticking to these rules in the Bid Ask Nation, you'll be making money like some of them.
It has been proven time and time again that when you follow rules religiously to the T, you do better. That's just it.
Show us the stock analyzer tool behind you, Paul.
So guys, I put the stock analyzer tool in here. I don't know what their growth rates are going to be. I put in 12, 15, 18%, put some share increase in here, put some margin in here. I don't know why their free cash flow margin is so much lower than earnings, but probably because they're investing so much. 14, 16, 18, blah, 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 blah. Look at my list, analyze. It looks expensive here, right? Now let's go change some assumptions. Let's go from 15, let's go 16, 18, 20% growth rates. Still expensive, but it's a lot closer, I guess. So I just look at this company and say this is just an expensive company. As they grow their number of stores, they're going to increase their debt. They're going to do a lot of other things. So it's not an apples to oranges comparison on this company. I'm going to wait a little bit on this company.
That's a take on Five Below. If you're interested in this concept of looking at financials, you can join our software below and argue with Paul in the comments if he's wrong. If you're a huge Five Below fan, I can't imagine.
I was just going to say, how many people are huge Five Below fans? I've never been to that store in my life.
They have great candy.
Do they?
Yeah.
It's different than other candy?
No, but it's like $1.
Oh, okay.
Tickle the thumbs
Probably
up.
hard as rock.
Tickle the thumbs up. Join Mo in the morning at 9 a.m. Eastern when he goes live, and we go live to the whole world Tuesdays at 2 p.m. Eastern. We are giving away a Tesla when we hit 100,000 subscribers, and Paul, that is coming so quickly. Prior to Thanksgiving.
I think according to Social Blade, it's going to be November 17th. Yeah, November 17th as of right now.
That's our take. Final thumbs up. See you next video.